Good morning, everyone, and welcome to our budget and tax update. It's a pleasure to put this on for you and to be able to go through this with you. It would be far nicer to be able to offer this in person in the office as well, but as is the way of the world, everything's on video and webinars these days. But at least we can interact with you and get involved and hopefully give you some useful information throughout this. We are obviously in the middle of the pandemic, which everyone is talking about, and that is the key factor really at the moment that's going to affect the economy, the fiscal policy, the government trying to balance the books and therefore the tax position. So I think it's a very important time for people to make sure they understand what the tax regime is, what it means for them, and to think about their own personal planning and business planning. Hence why I think this is sort of very important when we should be able to give a good insight as to where we are currently. And I think there will be continued changes over the next few years as everything unravels to do with the economy and the effects of the pandemic and what that means in terms of the government's policies and requirements on this. In terms of today, I'm Andy Baggett, managing partner at Clark Nicklin. I'm doing some introductions, but we have our key resident experts on hand to go through the information you're all wanting to hear. So we have Paul Draper, tax partner here at Clark Nicklin. Paul's career spans a significant amount of time now. He doesn't look old enough, but he's always been in tax and has been in a range of international, national, and independent practices. And has actually just passed a 10-year mark with Clark Nicklin. So Paul will start off on the core tax aspects, and then we've got Scott Herbert, who's financial planning partner and leads the team in the financial planning side of the business, and has been part of Clark Nicklin since we both set up the financial planning arm in 2005, and Scott's hit the 25-year mark and gone past that as a qualified financial advisor, and so has extensive experience dealing with clients on all aspects of their financial planning, both personal and corporate. So there are our experts for today. In terms of any questions, if you do have questions, please add them to the Q&A part. That you'll see an icon at the bottom that you can add in a question. We'll be collating the questions throughout the webinar, and then at the end of Paul and Scott's reviews, I'll go through relevant questions and we'll any that we can ask on the day and get Scott and Paul to respond to. We'll do that today. It may well be that there's more involved questions, and we will collate those and come back to you more specifically. So please do get involved and get the questions in there, and we'll pick those up at the end and go through those. So I'll hand over to Paul, who's going to start off with the core tax review and tax aspects to make you aware of.
Thank you, Andrew. Hopefully you can. Thank you, Andrew. Hopefully you can hear me all now. I think the thing you can say about the budget is it could have been a lot worse. Prior to the budget, there were lots of dire predictions about income tax rises, possibly introducing national insurance on dividends. And of course, we had people rushing around trying to get sales transactions done before the budget, because they were concerned that business asset disposal relief was going to be abolished completely and capital gains tax rates were going to rise. And of course, none of those things have actually happened. What we've actually ended up with is the big freeze in relation to personal taxes and the changes to corporation tax, which is one of the areas that we're going to focus on. Just starting with personal taxes, it is a case of nothing changing for the next 5 years. Personal tax, rates and allowances, the capital gains allowance, the inheritance tax nil rate band, all staying unchanged. Now, you probably saw in the press lots of comments about stealth taxes. And if allowances don't go up, then over time, you will pay more tax, but only if your incomes or asset values rises. If your income doesn't rise, your asset values don't go up, you won't pay more tax. And probably a lot of people on the back of the COVID pandemic and the effects of Brexit won't be seeing incomes rise or asset values rise for some time. So it's actually better than a rate rise. So as I said, it could have been a lot worse. Pension tax is frozen, no changes to rates. The lifetime allowance stays at just over 1,073,000. Now, I'm not going to talk about pensions. I'm going to leave that to somebody who knows what he's talking about. That's Scott later on in the webinar. But the main thing that happened in the budget, the big one, was the change to corporation tax. And again, there'd been lots of speculation before the budget about what was going to happen. There was going to be a rise, there's going to be phased increases and all sorts of things. And what we actually got, we didn't expect. But it's an old familiar friend, because the system that we're going back to, we've seen before. So just to summarize the changes, for the next 2 years, so until April 2023, there's no change to corporation tax. So that stays at 19%. But on the 1st of April 2023, which is the start of the corporation tax year, we will have a new system. And if your company is generating profits below £50,000, so the small profits limit, you will continue to pay tax at 19%. If your profits exceed £250,000, you go up to the main rate of 25%. But the interesting thing, and what the Chancellor didn't mention in his speech, is that if your profits fall in the band £50,000 to £250,000, then you actually hit an effective or marginal rate of 26.5%. Now that's actually an increase of about 39% from 19%. And a lot of our clients will find that a substantial chunk of their profit falls into that marginal band of £50,000 to £250,000. So looking forward, a lot of the planning, a lot of the thinking ahead is going to be focused on trying to avoid the effects of the marginal rate as much as possible. Some good news is the super deduction, which is coming in on the 1st of April this year, and it's going to last for 2 years. And we're going to look at the super deduction in a couple of minutes. So next slide, please. I feel a little bit like Chris Whitty saying that. And maybe in about 20 minutes or so, you wish you were listening to Chris Whitty, but hopefully not. So just quickly running through some of the other budget changes. Lots of people were rushing to try and buy houses before the 31st of March because the stamp duty reduction was due to end on that date. But the Chancellor has generously deferred that until the 30th of June. And even then, the exemption is going to be halved and then halved again, so it's going to sort of phase out. VAT registration threshold unchanged, and in fact, VAT itself unchanged. There's really no VAT changes that anybody would be interested in. The Chancellor has decided to allow both companies and partnerships and sole traders to carry losses back up to 3 years. Normally, if you make a loss, you can only carry back to the preceding 12 months. Presumably on the back of the pandemic, with companies, businesses making more losses, the Chancellor wants to be more generous. And so for 2 years losses, so that's the loss up to April 21 and any losses up to April 22, you can carry those losses back up to 3 years. And there's a cap of up to £2 million per year on that carryback. R&D repayable tax credits. So this is where you actually get money back from the government for surrendering your R&D losses. There's going to be a cap coming in from the 1st of April this year, which will limit your repayable credit to £20,000 plus 3 times the amount that your company pays in PAYE and NIC. Now, this measure seems to be aimed at stopping abusive claims where people were putting in, really top-heavy claims. So that's why that measure seems to have come in. We are going to look at R&D a little bit later on because it's a very important relief which is being reviewed. Finally, the VAT rate for hospitality, accommodation, etc., was due to end on the 30th of September, but the Chancellor is extending it. Sorry, it was due to end. It's now been extended to the 30th of September, and then it's going to be phased back up to 20%. And we won't see the 20% rate until about this time next year. Next slide, please. So this is really what we want to cover in this seminar, is planning ahead. What should we be thinking about? And I suppose it's a case of make hay while the sun shines. The corporation tax rise doesn't come in until April 2023, so there's a 2-year window for some planning there. And if you look at remuneration planning for companies, so this is how you get your money out of your company, the traditional model has been a low salary, say £9,000 a year plus dividends. Well, that can stay completely unchanged for the next 2 years. There's no reason at all for that to change. If you were paying dividends on A, B, C shares, sometimes called alphabet shares, that's still okay. There was a bit of a concern that HMRC were looking at alphabet share arrangements, but there's nothing in the budget to suggest that. So provided you're doing it properly, you can carry on paying out different dividends on different classes of share. I think the key thing to take away is that from April 2023, dividends may well not be the favoured choice of taking money out of your company. And the simple reason for that is the corporation tax increase. If you take out a salary or a bonus from a company, that's deductible for corporation tax purposes. Dividends, of course, come out of profits after tax. So if the corporation tax rate is rising to 25 or even 26.5%, the corporation tax deduction effect of salary and bonuses starts to swing things in favour of salary and bonuses rather than dividends. So you'll have to do the calculation for your own company depending on what level of profit the company is making, whether it's small main rate or you're in the marginal rate, and whether you're a basic, higher or additional rate taxpayer. Capital gains tax, despite all the excitement and worry about things that could change, nothing has changed. It is absolutely as it was. All the planning that we were doing before can still be done. So if you want to do a cash out type deal and enjoy business asset disposal relief, you can still do that. And we'll come back onto capital gains tax a little bit later on. Pension planning is unaffected. All I want to say about it is because the corporation tax rate has gone up, so you're now at 26.5 or 25% for a lot of companies, contributions to registered pension schemes become more attractive because you get more tax relief. But I'll leave Scott to talk about that shortly. And finally, inheritance tax was another favourite for a tax to be changed by the Chancellor. HMRC has been reviewing inheritance tax. The Office of Tax Simplification has been looking at it. And a lot of people were thinking that one of the things to go would have been the ability to make a gift, a pet. So you can make a gift to another individual and survive the gift by 7 years. It's a very easy way of planning to avoid inheritance tax. A lot of people thought that was going to go, but it's still there. If you have a will, you don't need to rush off and start rewriting it or making a codicil to the will. The rules are unchanged, and if you haven't got a will, please go out and get one. Finally, just as a reminder, if you're a married couple or you're in a civil partnership, you can have an estate of £1 million before you pay inheritance tax. That's because you have two nil rate bands of £325,000 each. And then on top of that, if you choose to leave the family home to your children or to your grandchildren, so your lineal descendants, you get the residence nil rate band of £150,000 each. So that's still there. Next slide, please. So moving on to the super deduction that we mentioned, the point to note is this only applies to companies. It doesn't apply to partnerships or sole traders. And it's a very simple relief. It's going to exist for 2 years, starting on the 1st of April. And it's a capital allowance. And quite simply, if you spend £100 on qualifying plant and machinery, so basically kit for the business, you will get an immediate in-year tax deduction of £130. So if you spend £100 net of corporation tax relief at 19%, it's only going to cost you £75. And there's going to be an additional deduction at 50% for what are called special rate assets. So those are the assets that at the moment you only get a 6% writing down allowance for. So those are things like cars and long life assets. So that's a generous increase from 6% a year. So I think what we're going to be looking at over the next 2 years is people wanting to maximize this deduction. And one of the things we're going to have to look at is when people are spending their money, because this is a capital allowance deduction. So we are into the capital allowances rules. And there are particular rules on when expenditure is incurred for capital allowances purposes. So I think the thing that we're going to start looking at are contracts for acquiring assets, when the obligation to pay for the asset becomes unconditional. And if you have hire purchase assets, there's a special provision that says that the asset must be delivered and in use by the end of the accounting period before you can get allowances. And the final point is the super deduction isn't quite the Brucey bonus that you might have thought, because if you come to sell the asset that you've had the deduction for, there is a clawback of the allowance, and the rate is at 130% of what you sell the asset for. So the easy way to think about that is the super deduction will be 130% of the net cost of the asset. So that's what you bought it for, less what you sell it for. So if you look at the corporation tax changes and the super deduction, I think the thing that people are going to be putting a lot of thought to is what's going to happen in terms of profitability in the next 2 years. So one obvious question is, should we be trying to accelerate profits so that we pay corporation tax at 19% before hitting maybe a higher rate after April 2023? So there may be scope for doing that. There are rules, accounting rules about income recognition in FRS 102. So you can't do what you want. You haven't got a completely free hand, but there may be scope for taking profits early realising income early, maybe releasing provisions, that kind of thing, so that they're taxed at 19%. The flip side of that is in terms of deductions, what we may want to do is think about deferring deductions. So we get our deduction at 26.5 or 25% rather than 19%. So the sort of things that we might be thinking about there are deferring bonuses, perhaps. We might also want to delay claiming capital allowances, because ordinarily you can choose when you claim capital allowances, and it may suit us to claim allowances later. We might pay some tax a bit earlier, but we'll pay less tax overall. You may wish to think about looking at your company year-end date and whether it's worth changing that. I think unless you have a very unusual profit profile with a very, very seasonal business, I don't think you're really going to feel any benefit from trying to change your year-end, but it's always worth a look. Next slide, please. So what other things can you still do? Well, happily, there's no change to R&D tax relief. But in the budget, it was announced that the government is consulting an R&D. But I think the good news is it doesn't look like the kind of consultation that's a precursor to having the relief abolished or vastly reduced. It does seem a genuine attempt to make it a more effective relief and make it more fit for purpose. So for the time being, R&D tax relief is still with us, and it's very generous. If you're a small or medium-sized company or a company, it's only companies which can claim it, you can get a 230% super deduction for qualifying revenue costs. So those are salaries, consumables, maybe the costs of external consultants and so on. You do need to make a claim. HMRC don't offer this up to you. So if you are carrying out some R&D work and not making a claim, you do need to look at it. And of course, this goes alongside the new 130% super deduction that we've just described, which applies to qualifying capital costs. That's your kit, that's your plant and machinery. There's no change to the patent box either, and that's good news. Very briefly, the patent box applies to companies again, and it allows companies to pay 10% corporation tax on the profits which flow from the sale of patented items or things which incorporate patented items. And the patent box is a wonderful thing. We've got some clients who virtually pay 10% tax on their whole profits because virtually everything they sell includes a patented item to some degree. And the value of the patent box is going to increase because the differential between a 10% rate and 25 or even 26.5 is bigger than the current differential of 9%. Now, I've had some discussions with clients about the patent box, and I've said to them, look, you should think about getting some items patented, because to claim the patent box, you need to have a registered UK or EU patent. And some clients say, well, there's no point because the patents are a waste of time. You're never going to enforce them. You can't sue on them. But that's missing the point, because to get the corporation tax relief, you just need to have the registered patent. Whether you ever choose to enforce the patent or not is a separate issue. So if you think there are things that you can patent, it's well worth thinking about it going forward, because it could generate very substantial corporation tax savings. We've touched on the salary dividend split going forward. So for the next 2 years, there's no real change, but we're going to have to start thinking ahead, because if you're going to have to start going over to, say, salary or remuneration, you might have to start changing people's contractual position. They might need contracts to give them more salary and so on. So there's no need to panic at the moment. There's plenty of time, but there is going to be a bit of a lead into this. So we're going to have to keep an eye on those kind of things. And finally, in terms of inheritance tax, as mentioned earlier on, there's no change to inheritance tax at all. So, make hay while the sun shines, if you will. If you want to make gifts to reduce your exposure to inheritance tax, now's a good time to do it. You can make a gift of any size to another individual. If you survive that gift by 7 years, it's free of inheritance tax. If you die between 3 and 7 years of making the gift, there's a tapering relief. But if you're happy to make a gift, why not do it and start that 7-year clock ticking? Another thing that people often forget about is normal expenditure out of income. So very briefly, if you have surplus income, if you can afford to spend some of that income on family, and you can create a settled pattern of expenditure, each of those payments is exempt from capital gains tax. So you don't have to survive the gifts, or the payments rather, by 7 years as you do with the gift. So it's a very, very powerful planning tool. Business property relief is still with us. That was another thing that was on the potential hit list. If you have a business asset and you qualify for 100% relief, you don't pay any inheritance tax on the value of that asset. That is still with us. And BPR features in some financial planning products, which Scott is going to touch on shortly. Wills generally almost always don't save you inheritance tax. What wills are about is organising your estate, providing for your beneficiaries, and dying tidily. So if you haven't got a will, get one in place, please. The final point on the family home is that the family home is usually the most valuable asset outside of the business, and it is liable to inheritance tax. There is a planning point on the family home that you can use to shelter a good proportion of the value of the family home from inheritance tax. It's a little bit technical. It relies on a statutory relief. You can still do it. Doesn't appear to have been stopped by the budget. So if anybody is interested in looking at that, please have a word with me after the webinar. And finally, business asset disposal relief, which was entrepreneurs relief, is unchanged. The Chancellor made a big reduction in the relief in the March 2020 budget when he reduced the lifetime allowance from 10 million to 1 million. Well, the 1 million allowance is still there and allows you to pay 10% tax on the first million of gain. Ordinarily, you pay 20% tax on selling a trading business. So basically, the relief is worth about £100,000. There's no change to the qualifying conditions. So the thing to think about here is if you've got shareholders in a company, for example, say one shareholder has a 4.7% shareholding, they can't qualify for relief because you need at least 5% of the ordinary share capital. So could you give them some more shares so that they can qualify for relief? Often between family members in a company, that's quite easy to organise. Equally, you could have somebody who does have more than a 5% shareholding, but they're not a director or an employee, in which case could you make them a director or an employee? Generally, that's quite easy to do. So maximise those reliefs if you can. Are we going to have rises in capital gains tax on the horizon? Well, there's no suggestion of that in the budget. There's no indication that anything is going to change. But I think people will still want to take advantage of business asset disposal relief while they can. So cash out deals are still alive and well. We've done a lot of these things for clients. You get HMRC tax clearance in advance of doing it, and you can get a decent amount of money out, up to £1 million, and pay only 10% tax. So I think people are going to be looking at that in the next couple of years. Happily, that's the end of my slot. So I will now hand over to Scott, who's going to cover the financial planning aspects.
Good morning. Can you hear me, Paul?
Yep, we can hear you, Scott. Yeah,
you can hear me. Thanks, Andy. Thanks very much. Well, good morning, everybody. Some of you will know me. My name's Scott Herbert, as Andy introduced before. I'm an independent financial advisor. Have been an advisor now for 27 years, believe it or not, this year. And I help a lot of Clark Nicklin clients, many clients all over the UK, plan for their retirement planning, investment side of things, inheritance tax planning. So what I wanted to do is just to give you a little bit of a whistle-stop tour on this webinar today, and just give you some examples of some of the old favourites, the pension planning, different types of investments. Also, what I wanted to look at is planning again, sort of inheritance tax planning as well. So first of all, what I wanted to look at, as Paul said there, as far as the retirement planning side of things is concerned, we've not seen any changes to the current funding opportunities. What we have at the moment are individuals are able to continue to fund up to £40,000 annually per tax year, although subject to earnings, which we'll look at shortly. Now, the different levels of tax reliefs that can actually be received in relation to funding an approved pension scheme are not only corporation tax, 19p in the pound from a company point of view. There are reliefs available for individuals ranging from 20 up to an effective rate of 60%, which we'll look at shortly. Now, what we are also able to do, and what will help many people, helped and are helping many people to do, is to fund in excess of £40,000. So, for example, if a company has had a good trading year, there may be money from earlier years that have not been drawn, there's an opportunity to fund into the pension scheme above 40,000, which I'll also give you sort of a live example of shortly. The whole idea of that, actually, with the pension funding, particularly for companies, is to reduce the corporation tax liability. I'll have a look at how that's working at the moment and how that may work in the future. We have helped many individuals fund quite large single pension contributions to help with both the tax and also bolster retirement funds for the directors, senior members of staff. So what I wanted to do is just to give you a little bit of an example of how we've helped somebody over this current tax year. We have a situation where we have a client who is a director of a company. The company has reserves, has made a good profit during the tax year, and the director was concerned about paying corporation tax on particularly on £160,000. Now, what's happened with the £160,000 if he didn't choose to fund a retirement, an approved pension fund? The tax liability would be £30,400 on the company, the corporation tax relief. Now, with Paul's example, what is mentioned earlier, with potential CT rates going up to 26.5, 160,000 could be taxed at 42,400 from a corporation tax point of view. So what we've actually done for this individual from the company is fund £160,000 into his pension scheme, and that has attracted tax reliefs of £30,400 for the company. From the employee's point of view, the director's point of view, we've enhanced the retirement pot by £160,000, no tax to be paid on that on the director. And what he's actually done, because he's 56 years of age, is to draw down the tax-free cash immediately of £40,000. Can we go to the next slide, Jono, please? So what we've done here is 160,000 from the company, 30,400 tax break for the company. The director of the company has 160,000 in his pension, has taken 40,000 tax-free cash, and that's £120,000 additional contribution in his pension. Both the company and the individual, I must say, were pretty happy. Now, what we've also done, I'm just working on a contribution for an individual at the moment. So this is an individual contribution. Now, what we've worked out for this individual is, whilst it is normally £40,000 maximum pension contribution during the year, we've carried back to 3 previous tax years, and great care needs to be taken on the shape of remuneration, not only in the current tax year, but the 3 previous tax years. Cutting a long story short, we've got to a position of a funding position for my client of £78,000. Now, the benefit of the client is, what we've helped him to do is to reclaim back tax within bands of 40, 45 and 60p in the pound. With the 60p in the pound, earnings between £100,000 and £125,000, you pay an effective rate of 60%. We've reduced that back to get the full personal allowance back for the client. It works wonders. So my client at the moment is going to be funding £78,000. He will get a tax break of £37,650. That's an effective rate of 52p in the pound. So what he's in a position to do here is to get that tax relief back. 20% of that's going to be done immediately for him, and he's going to reclaim £22,000 off his next tax return. So it's great from a tax point of view, and he's also bolstered up his fund there with nearly another £80,000. Now, what we do need to look at as well, particularly with some higher earners, there have been restrictions placed by Her Majesty's Revenue and Customs on pension funding. So again, great care needs to be taken. If we have individuals who are fortunate enough now to have earnings in excess of £240,000, you're now restricted to £4,000 a year. It's catching quite a lot of people out. So again, any high earners, be careful. We continue to be in a position with 25% tax-free cash from pension funds at retirement that you can take out. So if you've got £500,000, it's £125,000. And the lifetime limit, as Paul said before, is just over £1 million. In fact, it's going up to £1,078,000 from the next tax year. Opportunities we also have are for any individuals who are not working, maybe homemakers, etc. You can put a contribution in of £3,600 a year gross, and that would attract tax reliefs at 20p in the pound. So I think overall that's the retirement side, and really where I am is pensions don't have to be boring. From a corporation tax point of view, they can work very, very well. From a personal tax point of view, they can work very, very well. And believe it or not, for providing you with a decent level of additional income in retirement and a lump sum, they can also work very well. So definitely worth considering those options. Just moving away now from the retirement side, I just want to have a look at investment planning and the very simple things often that people don't fund. They haven't got any good old individual savings accounts. Now, what's happened over recent years, ISAs were fairly restricted. We had allowances of only £7,000 a year. We now have an allowance of £20,000 a year. We have clients who have built up substantial amounts of ISAs. The benefit of that, they're getting tax-free cash. The benefit of it as they get into the future, they can take the return tax-free. They're also a very good generator of income through the dividends to bolster up retirement provisions. You may have buy-to-lets, you may have pension provisions. This is a tax-free provision to take dividends to boost up income. Now, generally as a whole, we have a number of different styles of ISAs. Good old traditional cash ISA, no risk to capital. Apart from the effects of inflation, the returns at the moment are very, very low. I'm sure many of you have seen, or who may have cash ISAs, the returns are next to nothing. Stocks and shares ISAs. We have many clients who invest into bespoke portfolios, investment portfolios, stocks and shares in the UK, the US, global emerging markets, government gilts, money market funds. Those can range from a more sort of low, medium and high risk approach. What we have found very, very popular over recent years are smoothed ISAs. Smoothed ISAs are stocks and shares ISAs. The whole idea with the smoothed ISA is to have a lower level of volatility. So your traditional stocks and shares ISA will pretty much be doing this throughout. The smoothed ISA looks a little bit like this. Just watch that downward movement and back up and down. So the whole idea of it is to give you a return that's higher than a cash ISA, but lower volatility than stocks and shares ISA. They've been very, very popular with our clients over recent years, concerned about market volatility, concerned about Brexit. So again, definitely something that may be worthwhile exploring. Junior ISAs. We're in a position with junior ISAs now. Allowances have gone up over recent years. Those will allow you to save for your children. For example, previous allowances were £4,368. Over recent years, it is now £9,000. So again, is what we have the opportunity to do is to fund at higher amounts than we've been able to do previously. Now, I might be joining you now on a live picture, I hope, if that's come through.
Yeah.
Now, yeah, have you got it there? I've ironed a shirt this morning for this, so I think that's okay. Andrew, if I could just ask, can you see me now?
Yeah, you're fine there. You're in all your glory now, Scott. You're fine.
You're in all my glory there. Thank you very much. I'm just pulling my waistcoat down there for everybody. Okay, so that's the ISA side of things. And what I'm saying with the ISAs, they are very much a staple of financial planning. They are often a first port of call to start building up savings, or in fact with accumulated investments. Now, what I do want to do is to come away more from the more sort of mainstream side of things, the pension provision, the ISA provisions, to look at both venture capital trusts and EISs, enterprise investment schemes. Now, what we've got to mention with these types of schemes are they are higher risk. They are areas for individuals, more high net worth individuals, plan from an investment point of view and also from a tax planning point of view. So just to come away, I'm sure many of you have heard about VCTs. You may have VCTs, you may have EISs. A venture capital trust invests into smaller companies in the UK. And just as a highlight of it, you can put up to £200,000 a year in. It is to be considered as a 5-year investment. It is tax-free, the growth, and also any dividends generated are tax-free. So there is an opportunity there for individuals who may have a tax liability. It must always be funded in the year of the tax liability to reclaim 30p in the pound. So if you had £50,000, you put it into a VCT, venture capital trust, or a number of VCTs. If you have got the appropriate level of tax to reclaim on 50,000, you can reclaim £15,000. So very, very generous with the tax breaks. However, because of the generous tax breaks, you've got risk to capital. The fund values can go up and down. The funds are illiquid for the 5 years. You've got to stay in for the 5 years. So again, the VCTs are very good for high net worth individuals who can invest over 5 years or longer, who have a tax problem within a particular year, and who are looking for a level of tax-free income and growth. So we have many clients who invest into VCTs as part of their overall investment planning exercise and tax planning. And this is only a whistle-stop tour of the opportunities. Enterprise investment schemes, EISs, a bigger limit, £2 million. You have to hold the funds in for 3 years. An EIS is different to a VCT. It also invests into smaller, new start companies. It's a growth vehicle. It doesn't provide you with any income. The holding period, a VCT, is 5 years. An EIS is over 3 years. So again, you've got to be prepared to invest your money over 3 years. It is going to be a liquid. And very similar to the EIS, it comes with a 30p in the pound tax break. So what we've got there with an EIS, there are many different opportunities that you can invest into, our clients invest into, ranging from specialist funds, maybe in the technology sector. We have more generalist funds that will be diversified into several different investments. And with the EIS providers that we work with, all the way down to university spin-off companies, from Oxford University, from Cambridge University. So there's a whole range of opportunities as far as the investment side is concerned with an EIS. So again, just a little bit of a whistle-stop tour there of opportunities that may be available to you. Now, one thing that we have seen, actually, the Chancellor has confirmed, is the launch of the mortgage guarantee for small deposit homeowners. Now, this is going to be interesting in that we've already started to explore whether there are any options live at the moment for our clients. We've had a number of inquiries about it, for people's children, etc. There's nothing out there just at the moment. We are led to believe that a number of major players, Jono, if you can go to that next slide, please, will be offering lending facilities. So most of you there again can get down to the high street, Lloyds, NatWest, Santander, Virgin Money, etc., with the 5% deposit. At Clark Nicklin, not peddling our own wares, we'll be dealing with all these providers because we're independent advisors. The opportunity is going to be with borrowers purchasing properties up to £600,000. And we've got the stamp duty exemption has been extended until the 30th of June. Now, I have actually spoken to a number of conveyancing companies who've been really struggling trying to get the pension, get the mortgage deals and home purchases over the line for the 31st of March. So there's a lot of people, some of our clients here, who are breathing a little bit of a sigh of relief with the extension going to the 30th of June. Now, I think certainly I did do an article some time ago, a number of months ago before Christmas. One thing that concerns me, I think, with the mortgage side here, with the young ones getting on the market, are we going to go into an inflated market? And I'm quite sure a number of us remember many years ago when we started getting into negative equity, going back quite a number of years ago. That's a little bit of a concern for me. I think if we've got, whilst we may have more liquidity in the mortgage market, are the young ones going to be buying at inflated prices? I think we all know where the mortgage market is at the moment in the property market. Jono, if you can just move us along, if we can just take a look at business property relief. Okay, business property relief, as Paul mentioned before, is a tax relief for individuals, many of you, who may own a limited company or your own family business. So this is not a new thing. It was actually launched back in 1976. Now, the whole idea of business property relief initially was to help family businesses, because family businesses were in a position, if a major shareholder, father, etc., were to die, tax would need to be paid on the value of the business. That then forced many businesses into selling the business or having to raise significant funds to pay the tax. So it's not a new thing. Now, the way that we've been helping clients with business property relief actually has been assisting individuals who may have had their own business, first of all, and individuals who may want to save inheritance tax relief, inheritance tax taxation. Now, just to give you a little bit of an idea, the way that BPR, business property relief, works is normally you need to hold a business asset, a qualifying business asset, for a period of 2 years. What then happens after the 2 years, if it's in a qualifying asset, it could be your own business, it could be another investment after you sold your own business, or a new investment opportunity. After 2 years, the asset currently will stand outside your estate for purposes of inheritance tax. Now, to give you a little bit of a live example, I think it's always good to say, well, look, okay, how does it work from a practical sense? We had a client approach us 2 years ago. His mother had actually lost capacity to act. Therefore, we were slightly snookered. We couldn't make a gift. We also couldn't give the money away because mum was not in a position to do that. She held company shares in a BPR qualifying company for the 35 previous years. The company had to be sold for quite a significant amount of money. So the shares were bought back. Well, that was all good and well. The only problem is mum then had £500,000 added to her estate that would be then liable for 40% taxation as her estate was over £1 million. We had to rule out trusts. We had to rule out gifts. We had to rule out other options. What we did is we actually invested the money into a BPR investment portfolio into the UK AIM market, smaller companies. Many of them are over £100 million turnover. What we did, we invested the £500,000 into the estate. 2 years later, mum actually died. We've actually got the whole amount of that £500,000 outside the estate. That has saved her son and the family £200,000 in tax. So the BPR solutions are good for individuals who need to get the money out of the estate quicker than, say, a gift. If you were to make a gift or put something under trust, you have a 7-year clock ticking. It's going to take you 7 years to get the gift outside of your estate. With the BPR solution, actually in this live case, because the client had held BPR shares previously, we got the full amount out of the estate immediately. So it's worked extremely well for the client. They've actually made a capital gain on the investment as well over that period of time. So if we're looking here again, this is only a whistle-stop tour. How can you reduce inheritance tax liability? There's a number of ways that you can do that. Often the shortest duration of investment is to consider the BPR side of things. Yes, it is higher risk. It is going into smaller companies in the AIM market. Now, the main thing is with the BPR solution, in certain cases, you have actually got a reasonable level of liquidity in that if you want to remove money from your estate, and that's a future point, you might need it for long-term care or any other purpose, you can get your money back, subject to liquidity on the fund. That is something we look at very, very carefully for our clients. What are the alternatives? Making a gift. You can gift money to anybody that you want. However, it won't be outside of your estate in full for 7 years. You can look to put money under trust. A number of you on the call here today, we've helped you put money under trust. Again, that could be for grandchildren. That could be for children. We have clients who put property in for grandchildren under trust. Again, we need that 7-year clock to tick and to pass before that's outside the estate. And being slightly flippant about things is, if you want to reduce your inheritance tax liability, maybe buy a couple of Maseratis. You'll soon lose £50,000 on those over a couple of years. And then the other one is that we often find with people is, the good old one is, well, don't bother doing anything and then settle all the tax, pay it to HMRC. I believe it's voluntary to pay inheritance tax liabilities for your family. If your family's picking up the bill, it's voluntary. There are a number of things that you can consider starting from now, generally ranging from 2 years up to a 7-year strategy. So what you can do it piecemeal, and it could be BPR, it could be trusts, It could be gifts. It could be having an extra cruise around the world. There's a number of different things that we can consider for you. It's very much on a bespoke approach. It's very much has to fall in line with your attitude to risk. Do you want access to the capital? Are you prepared to give the money away? Do you want to keep hold of that capital, although get it outside your estate? There are a number of solutions that you can consider. Next slide, please, Jono. Well, that's it for me. Sorry if I slightly sort of rattled on there, a little bit rambled on. Just wanted to give you sort of a little bit of an idea, again, looking at from an investment point of view, what's out there at the moment, the good old ISAs, the pension side. I don't believe it's any longer boring. And then BPR solutions with the other areas of financial planning to help you achieve capital growth, income, and maybe get your estates in a more tax-friendly position as far as inheritance tax is concerned. Thank you. Thanks, Andy.
Excellent. Thank you both. That was a great run through. Obviously, it was, as Scott says, it was a bit of a whistle-stop tour on many things, but hopefully that's identified areas of interest and things for people to think about. We do have some questions that put forward that have come through. So one here on R&D, which will be for Paul. What types of expenditure fall into the R&D regime?
It's quite simple, actually. What you're really looking at are the employment costs of people who do the R&D work. So if you've got technical people or just people who are involved to some degree or other in the R&D project, what you do is you bring in a proportion of their remuneration costs. So that's salary, national insurance contributions, and so on. If you incur costs, say building prototypes, mock-ups, test rigs, that kind of thing, that generally falls into the category of consumables, and you can include those costs as well. And then the third category is if you have any subcontracted R&D work. So the rules are a little bit technical, but basically if somebody external to your company does some of the R&D work and you pay them for that work, you can bring in some of those costs. There are some particular rules, but generally capturing the costs is quite easy. The tricky bit with R&D is working out whether the company is actually carrying out qualifying R&D work, because there are some specific requirements, some hurdles to pass before you can claim relief. So it's not just any old R&D that will work.
Yeah, and I think, as you say, Paul, that's the key area to talk to us about anything where there is an enhancement of some technical knowledge or expertise. Do you want to sort of just refer to the correct phrase?
Yeah. So if you look at the basic test to have qualifying R&D work, you've got to overcome a scientific or technological uncertainty. So basically what that means is there's something you can't do and you can't buy the solution in already. So you've got to figure out a way of overcoming the problem. So if it's making a particular product or whatever, you've got to design something, you've got to write some new software perhaps that doesn't exist. And in doing that, you're overcoming this scientific or technological uncertainty, and you're making an advance in the general field of knowledge in your area. So the tests are a little bit hard to get your head around to begin with, but the basic idea is to try and limit R&D relief to genuine, new and original work, rather than somebody warming over something that's already been done.
Thank you. Got one for Scott here on pensions. Can pension contributions be made for spouses if they are connected with the business. So there's a sort of double pension being paid for two spouses.
Hi, Andy. Can you hear me?
Yep. Yep.
Thanks, Andy. The answer to that is yes. What we would need to do, what we'd certainly recommend, is that it has to be appropriate to the level of contribution that your spouse were to make to the business. Often having to listen to us all about our business is a big enough task for a lot of our sort of spouses. So what HMRC actually have is something which is called an wholly and exclusive for the purpose of the trade. So what that means, it just needs to be appropriate to the contribution they're making to the business. The answer to that actually is yes. Many of our clients do make a regular monthly contribution, or at the end of the year to assist with the corporation tax relief, they do make contributions for their spouses. We have many of our clients partners who have done that in the current tax year and in many previous tax years.
Okay, great, thank you. And sort of related element to this is the 40,000 limit on pension contributions covering both personal and company contributions?
Well, yes, it does. Again, that's correct. Yes, it does for the given tax year. However, great care needs to be taken at how you're being paid. So, for example, if we have an individual who's on an £8,000 or £9,000 salary and then has £50,000 of the dividends, if they wanted to contribute in themselves for that current tax year, it would actually only be based on the salary element, £9,000. However, if the company would like to contribute, they can actually put up to £40,000. So great care needs to be taken, whether it's an employer contribution or also from an individual. The other thing, as I mentioned to you previously, the rules is that you can actually go back a period of another 3 years. However, you need to have had an approved pension scheme in place previously during or before that period. If you don't, you will fall foul of the rules. You can't carry back when you've never had a pension previously. So what we actually do for our clients is to do a test in the current tax year, employee or employer contributions, and we go back current year, and then we go back 3 previous tax years to fill your boots. So again, you've got to be really careful how you do it, but there's some really good opportunities there.
Great, and questions that's just come through linked to this. If a company made a large contribution into a director's pension scheme in order to reduce CT and avoid falling into the marginal rate after 23, would HMRC query this? Would they say overall remuneration is too large?
Well, I think, again, it has to then come back to the wholly and exclusively for the purpose of the trade, who the contribution is for. So let's say, for example, if we have it for the managing director, the managing director, let's say, has a 6-figure salary. If we put £100,000 single contribution in, that should be okay. If we're in a position, again, I think, as I mentioned before, about the wholly and exclusive for the purpose of the trade, if we then have an individual who's earning, let's say, £10,000 a year, and then we have £50,000, that would be excessive. So you wouldn't be doing this for the janitor. It's going to be for the leaders within companies. And again, as long as it is wholly and exclusively for the purpose of the trade, it has to be proportionate to who the individual is within the organisation. So often this sort of planning that we're helping our clients with now and in earlier years are more senior members of the team. When we get to the higher end of the planning exercise, in order to meet the wholly and exclusive rules. The worst case scenario actually is if it were to go in and you get the CT relief and it were to be excessive. Yes, it could be challenged by HMRC and they would deny the corporation tax relief granted. But again, it's all appropriate. Who is the individual? What level of remuneration have they got? If it's the managing director who's been in the business for 15 years, is working 50, 60 hours a week, it would then be appropriate, generally.
Yeah, so I think probably the message there is to have a discussion with us around the remuneration levels, the roles, and we can make a judgment on that.
Andy, I would totally agree with that. Yeah, I do.
Okay. Jumping back to Paul to do with a capital allowances question. With the 130% relief, will that apply to cars? For example, ones with 0% CO2 electric cars?
From the information we've got at the moment, it's not going to apply to cars. So I think an important point to make, and this runs through all the budget proposals, is at the moment, they are just budget proposals. Nothing that I've described in relation to the super deduction or the corporation tax changes, none of those changes are yet law. We've got to go through the process of the Finance Bill and the Finance Act. It's possible the rules could change or get amended before we actually reach the Finance Act. So, you know, cars could be introduced at a later stage. There could be different rules for different kinds of vehicle. But looking at the guidance we have at the moment, it seems to be the case that cars are excluded from the super deduction. You could get them through the, you know, the existing capital allowances regime.
Thank you. I've got one that possibly crosses over both of you, to do with inheritance tax. With regard to the normal expenditure out of income, is the normal pattern of expenditure just covering standard living expenses? How is that assessed?
Okay, so the way normal expenditure out of income works is, what you do is you look at your income for the year. So you work out how much income you have. You then deduct your normal living expenses. So, you know, what you have to spend to live. And if you have a surplus, so if you have a surplus, that is what you can start to look at spending, if you will. So a common example would be, you know, you've got grandparents who've got plenty of income, for example, they don't spend a lot, so they have a nice surplus. So what they could do is they could pay for school fees for grandchildren. They could just pay the school fees. And if they're paying those costs regularly, that's the settled pattern of expenditure that I mentioned. It's that settled nature that indicates these aren't gifts. This is money that's been spent over time. There's no hard and fast rules on this. But if you can establish this settled pattern of expenditure, what you're doing is you're spending away your money, and you're stopping the size of your estate increasing in value. And the beauty of it is, every time you pay the school fees, or every time you take the family on holiday, or whatever you spend your money on, those payments are exempt from inheritance tax. So you don't have to survive each of those payments by 7 years, as you do with a big lump of capital gift. So it's a very powerful tool. It's a bit of an odd concept, this normal expenditure out of income. There have been some tax cases on it over the years. But basically what you have to be able to do before you die is demonstrate that these aren't gifts, and it was part of your normal way of spending your money.
Right, and just to elaborate on something you mentioned there. So say holidays, is that part of normal expenditure, even though it's discretionary?
The discretionary element doesn't matter. The key point is, say you had grandparents had, you know, 150,000 a year of income, and they only spent £50,000 a year to live, so they had 100,000 of surplus income. Ordinarily, they'd invest that with Scott's good help, and the value of their estate would go up and up and up, and therefore the building up an inheritance tax problem when they come to die, because almost inevitably their estate will be over £1 million. So to stop that accretion to capital, that capital growth of the estate, what they could do with their 100,000 surplus income is they could pay the school fees for the grandchildren each term. They could take the family on an annual holiday. They could just make a series of payments to help, say, their own children meet their living expenses. But what you're doing is you're demonstrating a pattern of spending your money. It's a slightly airy-fairy concept in some cases. But if you've done it for a couple of years, for example, that should be enough to demonstrate that you've created this pattern. Because if you don't have a pattern, if you just made one payment, that's sort of more analogous to a gift. So you sort of want a recurring series of payments.
Okay, great. So again, it's probably worth, if somebody's thinking that might be relevant to them, it's well worth a conversation and assessment to make sure the information is there in case HMRC do question anything in the future.
And the thing about inheritance tax planning like that, what I always say to clients is it's a win or a draw, because if it works, you save inheritance tax. If it doesn't work, you're only back to where you would have been had you done nothing. And you're only spending money that you would have spent anyway. So if you take the time and effort and you do it properly, you should get the saving. But even if it did get challenged and it didn't work, it isn't disaster. You're only back to where you were originally.
Great. Question back onto pensions. One for Scott, I think. Is there any expectation, or can you see in the future the 25% tax-free drawdown on pensions being changed, withdrawn, etc.?
Yeah, I think it's a difficult one to answer that. Certainly, we've been hearing about this for many, many years now. I've been, the last sort of 10 years we've been hearing about this. The answer to that is I'm not certain, to be honest. I think it would be a very unpopular tax on individuals, because it would therefore then be appropriate to define benefit schemes that doctors are in, that the nurses are in, that the police are in, for example, in the workplace, not only individuals in their own plans, personal arrangements. So do I see it happening? I'm not certain. Do I see it being a very popular tax, again, on all the doctors, nurses, policemen, school teachers, etc., and everybody else? I would see that being extremely unpopular. Would I see a Conservative government doing that? I don't think so. I'm not sure.
Okay. Well, that's the questions that are straightforward to answer. I think any more detailed ones we can come back individually. I think is the easiest way of dealing with those. If anyone hasn't put a question forward, then please do feel free to get something over to us, either on email or just give us a call, and Scott or Paul or myself would be very happy to take a call and discuss anything further. So I think unless there's any final questions being thrown through, I think we're done for the day. So thank you very much for everyone for attending, and I hope you found that useful. I think, as has been demonstrated, certainly to me, there's definitely a need to think about your personal and business financial planning and tax planning, and start to look at it early is a key message. There are changes afoot. There will be, I'm sure, further changes to come as everything unravels to do with the pandemic. So start talking to us early and thinking about your position and objectives, and get your planning in place. Any further comments from Paul or Scott?
No.
Not from me, Andy.
Right, that's great. Well, thank you very much to everyone, and stay safe and well, and we certainly hope to see you all soon.